December 10th, 2008. A penthouse on the Upper East Side of Manhattan. Two brothers sit across from their father. The father is 70 years old. He runs one of the most respected investment firms on Wall Street. He has been a chairman of the NASDAQ stock market. Presidents have shaken his hand. And he is about to tell his sons the truth.
I have to tell you something. The whole thing, the business, it's all just one big lie.
What do you mean, a lie?
A giant Ponzi scheme. There's nothing there. It's been gone for years.
$65 billion. On paper, the largest private fortune ever managed by one man, and every dollar of it was ink. Tonight, the biggest entry in the ledger. Welcome back to After Hours. I'm Vaughn, and this is The Ledger, where we follow the paper trail of greed all the way down to the wreckage. Every con needs one thing more than money. It needs trust. And no one in the history of finance built more trust with more people than Bernard Madoff. That was the genius of it. He didn't chase you. He made you beg to be let in. Here is the question that should haunt every investor who ever lived. How does one man steal $65 billion over decades in plain sight, while the people whose job it was to catch him looked directly at the evidence and did nothing? To answer that, we have to go back to the beginning, before the lie got big, when it was just a young man, a small office, and a reputation worth protecting. 1960. Bernard Lawrence Madoff is 22 years old. He starts a trading firm with $5,000 he saved, working as a lifeguard and installing sprinkler systems. He calls it Bernard L. Madoff Investment Securities. And for a long time, this part is real. Madoff is good, genuinely good. His firm helps pioneer the electronic trading that becomes the NASDAQ. By the 1980s, his market-making operation is handling a huge share of the trades on the New York Exchange. He is not a nobody clawing for respect. He is the establishment. His firm takes 3 floors of the Lipstick Building, a curved red tower on 3rd Avenue. The 19th floor, the 18th floor, legitimate business. Hundreds of millions in real trades. That part of the company actually works. But there is another floor, the 17th, and almost no one is allowed inside. Behind a locked door, away from the real traders, a second business runs in the shadows. Madoff calls it the investment advisory arm. He tells his clients he has a special strategy, something he calls a split strike conversion, complicated enough to sound brilliant, vague enough that no one quite understands it. What the clients understand is the result. Steady returns, 10, 12% a year. Good markets, bad markets, crashes, booms. It never seems to matter. The money just goes up, smoothly, quietly, year after year after year. And that, to anyone who truly knows markets, is the first impossible thing, because markets do not move in straight lines. Real returns are jagged. They scare you. Madoff's never did. The smoothness should have been the tell. Instead, it became the selling point. Here is how the trust spread. Madoff did not advertise. He worked the country clubs of Palm Beach, the charity galas of Manhattan, the tight-knit circles where one whisper does more than 1,000 brochures. A respected member would get in. Their returns would be beautiful. They would tell a friend, quietly, like sharing a secret. And the friend would come to Madoff almost embarrassed, asking to be allowed in. Sometimes Madoff would say no. The rejection only made them want it more. He pulled in entire charities, university endowments, pension funds, the life savings of retirees who were told, by people they loved and trusted, that this was the safe one, the sure thing. But there was no strategy, no split strike conversion. On the 17th floor, there was no trading at all. Instead, a small team led by a man named Frank DePascali ran what can only be described as a factory of fiction. They generated account statements showing trades that never happened. When a client wanted to see a strong year, they would look at what the market had already done and invent trades after the fact that would have caught exactly that move. Backdated, perfect, impossible. The paper looked flawless. Fixed statements full of detail, mailed on schedule. Every number on every page was a lie, printed in ink and stamped with the most trusted name on Wall Street. And the money? When an old investor asked to withdraw, Madoff paid them with the cash from a new investor walking in the door. That is the entire trick. That is all a Ponzi scheme has ever been. Robbing tomorrow to pay yesterday. It works perfectly, as long as more money keeps coming in than going out. For Madoff, the money kept coming in for decades. Which brings us to the people who tried to stop it. His name was Harry Markopolos, a financial analyst in Boston. In 1999, his bosses asked him a simple question: why can't you make returns like Bernie Madoff? So Markopolos sat down with Madoff's numbers and tried to reverse engineer the strategy. And within hours, he knew the returns were mathematically impossible. The market moves Madoff claimed to ride did not line up with reality. The line was too smooth. The trades, if they were real, would have required more options than existed in the entire market.
It took me about 5 minutes to know it was a fraud. It took another 4 hours to prove it.
Markopolos did not stay quiet. He took his findings to the Securities and Exchange Commission, the agency whose entire job is to catch exactly this. He went to them in 2000, again in 2001. In 2005, he handed them a detailed memo with a title that left no room for confusion. He called it, "The World's Largest Hedge Fund is a Fraud." He laid out 29 red flags. He practically drew them a map, and the SEC investigated in a fashion. They asked Madoff some questions. Madoff gave them confident answers. He was a former NASDAQ chairman after all. Who were they to doubt him? They closed the case. They found nothing. Because they did not truly look. Markopolos later said he feared for his life for years, certain he had uncovered something enormous, and equally certain that no one in power wanted to hear it. The warning was sitting in a filing cabinet in Washington, signed, dated, specific, and the machine kept running. But the warning being ignored is only half the answer. Because the other question is bigger. How did one office on one hidden floor take in tens of billions of dollars? One man cannot shake that many hands. He did not have to. He had the feeders. A feeder fund works like this. A professional money manager raises billions from his own clients, pension funds, foreign banks, the wealthy of a dozen countries. He tells them he has access to the legendary Bernard Madoff. He pours all of it into Madoff, and he charges his clients a handsome fee for the privilege of doing so. These were not naive retirees. These were sophisticated firms with armies of analysts. Fairfield Greenwich, a division of one of the largest banks in Spain, funds in Switzerland and Austria and the Cayman Islands. Together they funneled a fortune into the 17th floor and collected fees on every dollar. And here is the quiet scandal inside the scandal. Their entire job was to check, to do what is called due diligence, to verify that the man holding the money was actually doing what he claimed. If a single one of them had demanded real proof of a single trade, the whole thing would have ended years earlier. They did not demand it. Why would they? The returns were beautiful. The fees were enormous. And as long as no one asked the question out loud, everyone at the table got paid. The feeders did not need to know it was a fraud. They only needed to not look too closely. And not looking too closely is the easiest thing in the world to do when looking might cost you a fortune. So the money came in from everywhere, quietly, through respectable middlemen in expensive suits, until the day the world stopped and everyone reached for their money at once. 2008, the financial crisis. The one thing a Ponzi scheme cannot survive: fear. When markets crash, people want their cash. All at once, Madoff's investors, panicking, started asking to withdraw their money. Not millions, billions. Around $7 billion in redemption requests landed on a business that had no investments to sell. Because there were no investments. There never had been. For the first time in decades, more money wanted to leave than was coming in. The arithmetic that had held the lie together for nearly 40 years reversed in a matter of weeks. And once it reverses, there is no stopping it. By early December, Madoff knew it was over. He had perhaps a couple $100 million left, pocket change against what he owed. He started talking about paying out bonuses early. His sons, Mark and Andrew, who worked in the legitimate side of the firm, asked him why. And that is when he told them, in the penthouse, that the whole thing was a lie, that it had been gone for years, that he was, in his own words, finished. His sons listened to their father confess to the largest fraud in the history of finance. And then they did something that still divides this story for people who hear it. They walked out, called their lawyer, and turned him in. December 11th, 2008. FBI agents arrive at the penthouse. The lead agent asks Bernard Madoff if there is an innocent explanation.
There is no innocent explanation.
And with that sentence, the most trusted man on Wall Street put out his hands. The number that emerged was almost impossible to hold in your mind. $65 billion. The total value on all those fictional statements. The wealth thousands of people believed they owned. The real cash that vanished was smaller, but still staggering. Somewhere around $17 to $19 billion of actual money. Gone. And behind that number were people. This is the part the headlines rush past. Retirees who lost every dollar of their savings in a single afternoon. Charities that had to close their doors overnight. A Holocaust Survivors Foundation. Gutted. Universities. Hospitals. Families who had trusted one man with 3 generations of work. Some could not survive it. In Madoff's own circle, a respected French money manager who had funneled clients into the fund took his own life weeks after the collapse. 2 years to the day after his father's arrest, Madoff's own son, Mark, died by suicide. The wreckage was never only financial. On March 12, 2009, Bernard Madoff pleaded guilty to 11 federal felonies. He offered an apology to his victims, his back to them in the courtroom. Many did not accept it. On June 29, 2009, the judge handed down the sentence, 150 years in federal prison, the maximum. A symbolic number, the judge said, a message that this crime was, in his word, extraordinarily evil. Madoff went to a federal prison in North Carolina. He never came out. He died there in 2021 at the age of 82, still owing a debt that no sentence could ever cover. A court-appointed trustee named Irving Picard spent more than a decade clawing back money from those who had withdrawn more than they put in and recovered a remarkable amount, billions of dollars, returned slowly to the victims. Some measure of justice. Never enough. So how did one man do it? Not with a complicated machine. With a simple one. He understood that people do not check what they want to believe. He gave them smooth, beautiful, impossible numbers and the comfort of a name everyone else already trusted. The fraud was never really in the math. It was in the trust. And the warning was there the whole time. A man in Boston did the arithmetic and screamed it for 9 years. The paper trail always exists. The only question is whether anyone is willing to follow it before the wreckage, instead of after. If a return never has a bad year, if it only ever goes up, smooth and certain and too good to question, that is not a miracle. That is the oldest entry in the ledger. There's always another name in the ledger. A man who sold time itself. A boy who built an empire on a coin that wasn't real. Tell me, in the comments, whose paper trail should we follow next? I'm Vaughn. This has been The Ledger. Watch your money. Watch the people who tell you not to.